Today is Thursday, December 5th, 2024. My name is Lucy Wang, and I'm the Deputy Commissioner for the Office of Special Counsel at the Department of Insurance. The purpose of this discussion is to provide all interested stakeholders an opportunity to present statements or comments regarding the contemplated future regulations. Our next speaker is Karl Susman.
Thank you, Deputy Commissioner Wang. I appreciate the time to talk a little bit this morning. I want to talk about how important reinsurance actually is to a competitive and solvent insurance market. So reinsurance, just a quick review so everyone knows, it's insurance that insurance companies purchase in order to share the financial risk that they've taken. Sharing is good. It puts more dollars behind the insurance policy being sold. So common sense tells us if we want to ensure that there's enough money to pay claims, we would rather purchase a policy from a company that's backed by several insurance companies or several reinsurance companies than just one company, right? Many wallets of money is better than just having one backing your policy. So as a consumer shopping for insurance, it behooves me, it protects me to have the option to purchase from an insurance company that utilizes reinsurance in their business model. So think about it like diversification, right? You don't want to put all your eggs in one basket. You've seen large insurance companies, I won't call any out by name, but we know who they are, to the extent that their financial rating has dropped significantly by AM Best. They're non-renewing policies at an alarming rate, and obviously they're not adding to their risk pool by offering new insurance policies. Some of this could have been avoided by having sufficient reinsurance in place. So we see that reinsurance is protection for consumers. It also means more financial security for the insurers, which will then allow them to write more insurance policies. Again, more policies, good for consumers, right? We get this? Reinsurance is good for consumers. The problem is the way our current insurance regulations in California work, we literally provide a disincentive for insurance companies to purchase reinsurance. And it's not hyperbole, it's a financial fact. Insurance companies in California have to pay a premium, actual dollars out of their pocket to buy reinsurance. It's a cost, it's an actual expense. In California, the Department of Insurance has the final say on rates that insurance companies charge, and they require detailed information about how those rates are arrived at. But guess what? In the calculation of those expenses, the department does not permit insurance companies to look at the actual costs they've paid for reinsurance. So insurers are literally penalized out of their own pocketbook if they do what we know is better for California consumers and purchase reinsurance. Finally, I want to mention that even the Little Hoover Commission, which is an independent organization, last month published a report titled Building a Stronger Home Insurance Market in California. And in it, they point out that rising reinsurance costs and their inability to account for expenses in their rates is creating significant financial pressures, making it harder to maintain their claim paying capacity or to take on new policies in the state. Also, California Fair Plan President Victoria Roach is quoted as saying that reinsurance costs is her top priority as Fair Plan struggles to maintain actuarial soundness. So make no mistake, this isn't about insurance company greed. This is about